Managing investment risk, how to avoid losing money. Welcome to this educational video where we'll tackle one of the most important aspects of investing, managing risk. Whether you're just starting your investment journey or thinking about taking the plunge, one thing is likely holding you back: fear of losing money. Today we're here to help you overcome that fear by teaching you how to understand and manage investment risks effectively. Risk is a natural part of investing, but the good news is that it doesn't have to jeopardize your financial goals. By the end of this video, you'll have the tools and strategies to confidently safeguard your investments, make informed decisions, and grow your wealth responsibly. Let's get started. Before diving into solutions, let's first understand what investment risk actually means. In simple terms, investment risk is the possibility of losing some or all of the money you put into an asset. All investments, whether they involve stocks, bonds, real estate, or even savings accounts, come with some level of risk. Common types of investment risks include market volatility, economic downturns, inflation, and even company-specific challenges like leadership changes or scandals. But here's the key takeaway: risk can be managed. It might sound intimidating, but by acknowledging and understanding risk, you put yourself in a stronger position to control it rather than letting it control you. Managing investment risk doesn't mean avoiding it entirely. It means taking calculated steps to offset potential losses while maximizing your chances of achieving your financial goals. Before anything else, set your financial goals. Why are you investing? Is it to save for retirement, build a college fund, or purchase your first home? Your goals will shape your investment strategy, including how you manage risk. Along with setting goals, assess your personal risk tolerance. Risk tolerance refers to your ability and willingness to endure fluctuations in your investment's value. Ask yourself these questions. How would you feel if the stock market dropped 10% tomorrow? How long are you willing to wait to recover potential losses? Are you financially prepared to handle short-term risks to achieve long-term gains? Understanding your comfort level is critical because it ensures you're not taking on more risk than you can handle. Matching your investments to your risk tolerance helps you stay the course, even during uncertain times. One of the most effective tools for managing risk is diversification. You've probably heard the phrase, "Don't put all your eggs in one basket." That's essentially diversification in investing. Diversification involves spreading your investments across different asset classes, sectors, and geographic regions to reduce the impact of any single factor affecting your entire portfolio. For example, if you only invest in technology stocks, a downturn in that sector could significantly affect your portfolio. But if you diversify by investing in other sectors, such as healthcare or consumer goods, your losses in tech may be offset by gains elsewhere. A diversified portfolio might include a mix of stocks, bonds, real estate, mutual funds, or exchange-traded funds, ETFs. Each asset class reacts differently to market conditions, creating a built-in safety net for your investments. By diversifying your portfolio, you're essentially buying protection against risk. It doesn't completely eliminate it, but it significantly reduces the likelihood of massive loss. Let's take diversification a step further and talk about asset allocation. Asset allocation is the process of dividing your investments among different asset categories, like stocks, bonds, and cash, based on your financial goals, risk tolerance, and time horizon. For example, if you have a high tolerance for risk and a long investment horizon, you might allocate a larger portion of your portfolio to stocks, which historically offer higher returns, but also higher volatility. On the other hand, if you're nearing retirement and want to preserve your capital, you may favor bonds, which are generally more stable but provide lower returns. Here's a simple guideline. Younger investors may opt for a portfolio heavy in stocks, for example, 80% stocks, 20% bonds. Middle-aged investors might prefer a balanced mix, for example, 50% stocks, 50% bonds. Retirees often prioritize stability with a conservative portfolio, for example, 20% stocks, 80% bonds. Regularly reassessing and adjusting your asset allocation as your goals or circumstances change ensures that your investments remain aligned with where you are in life. A mistake many new investors make is trying to time the market. Timing the market involves buying and selling investments based on short-term movements with the hope of maximizing gains and avoiding losses. While it may sound tempting, trying to predict market moves is risky and unreliable for most investors. Instead, focus on time in the market. This means holding onto your investments for the long term and allowing your money to grow through compounding. Historical data shows that even when markets face temporary downturns, they tend to recover and deliver steady growth over time. Here's a practical example. Let's say you invested $1,000 in a diversified portfolio 20 years ago. Even if there were periods of market downturns, the value of your investment today would likely be significantly higher due to long-term growth. The takeaway? Stay patient. Jumping in and out of investments out of fear or greed often leads to losses. Stick to your plan and trust the power of long-term investing. The key to managing risk is making informed decisions when selecting your investments. Start by researching and evaluating each potential investment opportunity. Here are a few things to look for. Company financials. Review the company's earnings, revenue, and debt levels. A financially healthy company is less likely to take a hit during economic challenges. Market trends. Understand broader market conditions and economic indicators that could affect your investment. Leadership and management. Companies with strong, consistent leadership tend to perform better over time. Avoid making emotionally driven choices or following trends blindly. Remember, good research leads to better decisions. To wrap up your toolkit for managing investment risk, here are some practical, easy-to-implement tips. Build an emergency fund. Before you start investing, establish a financial cushion to cover unexpected expenses. This ensures that you won't need to sell investments prematurely. 2. Start small. As a new investor, begin with small investments while you learn the ropes. Gradually increase your contributions as you gain confidence. 3. Revisit your portfolio regularly. Conduct periodic reviews to ensure your investments align with your financial goals and risk tolerance. Stay calm during market downturns. Resist the urge to make rash decisions based on short-term market movements. 5. Avoid putting all your money in hot trends or risky stocks. What's popular today might not hold its value tomorrow. By adopting these habits, you not only mitigate risk, but also give yourself the best chance to succeed as an investor. A big part of managing risk lies in your mindset. As tempting as it is to focus on short-term results, successful investors think long-term. Focus on your goals, trust your strategy, and accept that occasional ups and downs are part of the investment journey. When you manage risk effectively, you'll find opportunities instead of fearing the unknown. Let's quickly recap what we've learned about managing investment risk. Risk is an inherent part of investing, but it can be controlled. Setting clear goals and understanding your risk tolerance are essential first steps. Diversifying your portfolio and allocating your assets wisely reduce vulnerability to loss. Focus on time in the market, not timing the market for long-term growth. Make informed decisions through research and stay disciplined during market fluctuations. By implementing these strategies, you'll be well equipped to navigate the world of investments, minimize risk, and maximize potential gains. So are you ready to take control of your financial future? Start small, think big, stay patient, and let the power of smart investing work for you. Managing risk isn't just about avoiding loss. It's the key to achieving your financial goals and building lasting wealth. Thank you for joining us today, and don't forget to like, share, and subscribe for more insights on smart investing. We're here to help you every step of the way. Happy investing.